In terms of the outlook going forward, what we are actually witnessing as the economy has been unlocked has been a V-shaped recovery.
Number print of -24 is clearly a very large slowdown. But on the other hand, since then we have been easing up, and many of the activities you can see around you have come back.
You're certainly seeing a recovery. The question is really, again, not on the growth rates per se, but the recognition that in the first quarter itself, the country has lost approximately 13 lakh crores of income.
Even in the fourth quarter of this financial year, we actually don't think growth will be able to get back into a positive territory.
Good morning. Welcome to Bazaar Morning Call. I'm Lata, with me Anuj and Sonia, and that montage presented the most important number for the macroeconomy, the GDP data. But I'm going to underplay it. I'm underplaying it because it is past tense. It is in the price. Yes, it's a little worse than what our poll threw up, but there were some people even in our poll who pointed out to a -28% GDP. So the reason why everybody gave you a -18% was they thought the CSO will not be able to capture the fall in the informal sector. So it was more doubts over CSO that made people guess -18 and -19. If you looked at the Google activity and the other data, anybody should have got it that this is a -30% or -25% contraction. But it is all past tense. Even if economists were to revise downward the full year number from, say, a -5 to a -7 or from a -7 to a -8, I don't think that's going to move the needle. According to me, the most important number is what Sonia is going to give you, and that will be the auto sales numbers, because that's forward-looking. That indicates how much and how fast we're recovering. The other thing that will move the market will be if there is any further developments from China, and thirdly, how the AGR verdict moves. That will affect about 3 or 4 stocks, but it is just an overhang on the market, and that will be important. Just one more point. The Reserve Bank came in with a mini monetary policy yesterday, very positive for bonds and therefore positive for all finance stocks. So I'm not all that negative with that uglier than expected GDP number. Anuj, what's your sense? Yesterday we saw this big knock of about 1,500 points on the Sensex from the day's high.
Yes.
So is it done and dusted, and now we are back to the 11,250 to 11,450 range?
Yeah, good morning, Lata. Good morning, Sonia. You know, we, of course, missed you yesterday. I was making this point to Sonia yesterday that this is the market where the short positions are at historic lows. And if there's a trigger, the market falls, the falls would be big. And that's what happened yesterday. You know, it's a shakeout. Just look at the internals and it will tell you. Now, I'm looking at the data today morning and I'm comparing it to the data that we had yesterday morning. The put-call ratio yesterday morning when we started was at 1.64. It's fallen to 1.17. The India VIX was at 18.35. It's gone up to 22.84. The FI long exposure when we started trade yesterday was 77%. That's fallen in just one day to 58%. Almost 20% long positions shaved off. And if you see the Nifty from the 20-day moving average, it was way above 300 points. Now it's just only about 45 points. Just some more numbers. The FI data in futures and options. Index futures longs cut by about 24,000. Shorts, 27,000 added, and look at index put longs and index call shorts. Short point is that yesterday was a massive shakeout
of reduction of longs.
Of reduction of longs, and finally some shorts coming in the system. You know, shorts are important in the market because when you don't have shorts, the market is vulnerable to the kind of fall it had yesterday. Just to give one last point before I talk about today's trade. Even after this mayhem of yesterday, look at the market this in August. For example, the Bank Nifty, which was down 3%, yesterday still up 10% in August. Small cap, which was down 5% yesterday, still up about 11% in August. So it's still been a very strong market. It's just that because the market was so heavy, it fell under its own weight. And like I said, overbought markets fall big when there's any kind of trigger. But now in one day, the market's corrected a lot of excesses. And what it's also done is given you a beautiful stop loss to work with, which is yesterday's low. Yesterday's low is also the 20-day moving average. So, you know, give or take 25 points here or there, 11,325 becomes your sacrosanct stop loss. If you are still long on the market from the positional point of view, 11,230, which was the last low. So these are the two numbers that you want to keep an eye on. On the Bank Nifty, the first test of 200-day moving average was rejected, which is what happens. The first test is always rejected, but the rejection is not big. We haven't even, taken out Friday's bar. So let's see if we have a second test of 200-day moving average. That will be more important. My sense is that yesterday's low is sacrosanct, and if that holds, perhaps the market could start to recover once again.
Okay, and much will depend on what Sonia says. Because Sonia, what are the expectations? I mean, I directly want to get into auto sales because that will hold a lot of hope for the market. It will negate the negativity of GDP. Do you think they're going to be good?
They will be good for sure. So August sales will be much better than June and July. We also had the festive months, right? In Maharashtra, there was Ganpati. In Kerala, there was Onam. So because of that, there was a lot of inventory refilling that took place at the dealer's end. And because of that, the numbers will look quite good. The two pockets that will look good are passenger vehicles and two-wheelers. The other thing to remember is that normalization of the supply chain has been a big positive for many of these industries. And tractors will also look good because of the good monsoon as well as Kharif sowing. So rural demand has been pretty strong. But these stocks have already run up significantly. So, you don't know if there could be profit taking post these numbers as well. But the numbers will be good definitely. And in fact, dealers tell us that sales are now back to pre-COVID levels, especially for passenger vehicles.
Okay. Well, the only point is that we have lost 3 months, as Samir Arora was pointing out. Can we make that up?
Yeah.
Or is this just, even after making up, it's just a 3-month data. So that is the big worry. But let's see what they say after they declare the auto sales numbers. That, I guess, will be very important.
Absolutely. Yeah. So I think the commentary, right, from the managements. But Anuj, before we, toss to our guests, I just wanted your thoughts on what happened with the FI data, because a large part of it was MSCI rebalancing that you saw because of Bharti. But there was a lot of selling in the F&O market. What does that tell you about how perhaps the first part of the September series could shape up?
A lot of that was unwinding of long positions, Sonia, like I explained. But, you made an important point on this FIS selling and this MSCI rebalancing, because a large part of market equation, look, if this was a market which had fallen because of global cues, I would have been much more nervous. But as long as the dollar index is where it is, and as long as global cues are benign, on our own, I don't think the market's going to fall a lot. So that way, the more important cue would still be going forward to track the dollar index and the FI number in the cash market. That will be more important.
Okay, of course we will do that, but look at the dollar index. It's absolutely mouth-wateringly falling, so very much to our advantage. With that, let's get to some equity advice. This one comes from Neelkan Mishra of Credit Suisse. He says, to get to the consensus full-year GDP number of minus 5.5% for FY21, second quarter to Q4 must see at least a 1.1% growth, which appears unlikely now, implying estimate downgrades. Monthly IIP and services PMI series are flawed measures, but do not yet show a meaningfully better growth pattern.
Okay, well, we have another comment coming in from Jonathan Garner of Morgan Stanley, who says that the MSCI emerging market in Asia Pacific ex-Japan delivered in-line results on a dollar basis, but 14 to 16 percentage points on breadth. The strongest sub-region was the EEMEA, which includes Eastern Europe, West Asia and Africa, and the markets were Taiwan and Brazil, while larger misses were seen in Singapore and India. By sector, work-from-home beneficiaries saw a solid beat, but autos also topped estimates.
Topped estimate, good. Okay, now money market, and this is very important today. First, the rupee, of course. Bhaskar Panda of HDFC Bank says USD INR pair has broken below a technically important 200-day moving average level a few days back. The rally in USD INR prices yesterday may not sustain beyond a point. He expects 73.74 to act as a resistance for today. He says we could witness another choppy trading day, with the range being 73.25 to 73.55. Incidentally, the appreciation of the rupee was because the Schneider money was coming in. I mean, that's the gossip from the grapevine.
Okay. Well, at a 6-month high, right, for the rupee, just some bit of profit taking yesterday. But on the bonds, Bhaskar Panda says yesterday the RBI had come out with measures to increase the held to maturity of banks. This was a measure the market was expecting. Hence, the bond yields could easily come down gradually. He expects the benchmark 10-year yield to gradually come towards the 6% mark. For today, he says we could expect the 10-year benchmark to trade within 6.05 to 6.10% range.
Okay, let's talk about the global cues then. Here's Mangalam with the world view.
Well, there were rather mixed cues coming in from the global markets yesterday, but benign nevertheless. Dow Jones and S&P 500 ended lower, but remember, behind them, they've put together a fifth consecutive month of gains and the best August for both these indices from a time before I was born as well. So we had the Nasdaq, which did well too, almost about 0.7% higher, and that was primarily on account of Zoom. We've done a lot of Zoom calls during the lockdown. Well, the company reported a blowout quarter. Revenues grew by 4 times, and as a result of which the shares, which were already on fire, jumped a further 17%. And the Nasdaq, which is considered a slightly younger index, actually put the best August in the last 20 years. European markets were also lower in yesterday's trading session, and we'll keep an eye out on how the dollar index pans out. In fact, it has been rather benign, now sub that 92 mark, so positive for all the emerging markets. Talking about emerging markets as well as the Asian markets, the key data to watch out for would be the Chinese private manufacturing data, which is due today, and as a result of which the Asian markets more or less mixed, with the Kospi as well as the Nikkei outperforming, and as a result of which the SGX Nifty is actually indicating a firecracker of a start.
Okay, thank you very much for that, young man. At least you were older than 20 years, I assume. At least the Nasdaq's highest in 20 years.
Making all of us feel old, right, with that comment?
No, I don't feel. I'm pretty young. I'm very close to Banglam's age. Okay, we have to get to know what the FII mindset is and how are they approaching this GDP number, this Chinese skirmish, and the Indian growth story in general. Mark Matthew of Julius Bank Julius Baer joins us. Good morning, Mark. Thank you very much for joining us. And what's a very important day, the day after the big GDP number. At -24, we are, I think the data will run for you. We are the worst GDP count when you look at developed countries or developing countries. Is that going to be a negative, or will that be treated as past tense?
I think it's past tense. I think it was the bottom for GDP data in India, because high frequency data already tells us that that was the average for 3 months, but high frequency data already tells us that there was a significant improvement in July and August over May and June. Yeah, so I think we should look at it in the rearview mirror, as we always should with GDP, frankly. It's probably the most lagging indicator you can get.
Mark, good morning. So let's look at the forward-looking indicators and the current indicators. The dollar is on the way down this morning below 92. You reckon emerging markets could keep seeing big inflows of carry trade and they could keep moving higher from here, including India?
I reckon so, yes. It's the biggest thing. You're very right to identify it. I think it's the number one thing when it comes to asset allocation for emerging markets. And why were emerging markets so lackluster throughout the last 10 years? The primary reason was the dollar, because when the dollar's going up, people don't want to buy emerging markets because they don't want to lose money in the currency. And so I thought Jackson Hole was important because the Federal Reserve signaled looser for longer. So on the back of that, we have extended our own call for the first rate hike in America from 2022 to 2024. So we think no rate hikes for the next 4 years in America.
Okay.
Therefore, the dollar should be soft.
All right, so no rate hikes for the next 4 years. Mark, hi, good morning. So what does this mean for emerging markets like India? Do you think this liquidity gush is something that could continue and could take markets like India higher despite the run-up that we've already seen?
Yes, I do. I think the data is going to improve, the economic data. I think that of course, for India, most unfortunately, it's one of the places in the world where the virus cases are still rising. But globally, they have plateaued. They've been running sideways for the last few weeks. And of course, I can't say for sure there will be no big second wave. There could be, but I have a feeling there won't be, because we are now more knowledgeable about how to control the outbreaks and social distancing, that kind of thing. So anyway, yes, I do think that the emerging markets in India can continue to go up, primarily driven by a weaker dollar.
But where would India be in your pecking order? Considering, of course, as you pointed out, the higher number of infection numbers coming in every day, and this lagged GDP data, regardless, being worse than competing peer countries.
I have to be honest, I don't look closely at Russia or Brazil, but I'm constructive on commodities because of the weaker dollar. And so they could be fine. Not really constructive on oil, which both of those are kind of proxies for. So India, it's good. The big thing that holds it back, in my humble opinion, is that the really interesting part of the economy that everybody wants to buy is not listed on the stock market. It's in venture capital and private equity. New economy, e-commerce, digital healthcare, all that kind of really interesting stuff that has growth rates in the teens. And the difference between India and China is that China does have that, and it's got it in massive size. Ant Financial it could be the biggest IPO in the world. It could be bigger than Aramco. And there's a lot more of those in the pipeline. So last year, MSCI China, the new economy sectors, which are technology, telecoms, consumer, and healthcare, they surpassed the old economy sectors, financials, utilities, industrials, materials, oil and gas. They surpassed those in size. So what I'm trying to say is that China's index is becoming like a S&P. Technology and that kind of interesting space is the largest part of it. India remains more of an old economy cyclical story. So therefore, I can't put it up alongside China.
Okay. Point taken, Mark. We do have Reliance, which is turning out to be a technology stock, and we have a bunch of IT stocks which are not quite new economy. Thank you very much, Mark Matthew, for joining us. The key positives that Mark is putting on the table is that the dollar is declining. That will mean more flows into emerging markets like India. And yes, commodities should do well. We have a goodish bit of stocks that are dependent on commodity prices as well. But I just want to put, we were running for you the numbers of the GDP in comparison to India. Clearly, as the data showed you, India is worst in terms of Q1 GDP cut. Here's a quote that we got from Ruchir Sharma, who gave us that data. Ruchir points out that there has been a very clear relationship between the severity of the lockdown and the extent of the economic decline. Given the fact that India had about the strictest lockdown in the world for much of the second quarter, it should come as no surprise that its economy experienced the severest contraction in GDP during that period.
Okay, this reminds me of what L&T Shankar Raman had told us, right? If you tie my hands and my legs, then how do you expect me to perform? 70 to 80% of India was shut down during that period. So I guess this was on expected lines. But in any case, let's take a quick break on that note. On the other side of the break, plenty of stocks to talk about. Our entire research team will be with us, so don't go anywhere.